Welcome, aware. Menda, tumalang, molo,
Yeah.
sabana, hu kandat, and a warm welcome to the Induvo Knowledge Cast, the podcast where your curiosity meets insightful conversations. Namuzi Rikoamba, lekker discussion. Today we're taking a deep dive into something that's a cornerstone of business not just here in Metsansi, but globally. International Accounting Standard 16, or IAS 16 as it's more commonly known.
That's right. Specifically, we're going to unpack how IAS 16 helps businesses make sense of their property, plant, and equipment, those big-ticket items that keep the wheels turning.
So essentially, it's like a set of guidelines for keeping track of everything from the delivery backy to the factory floor.
Exactly. Imagine trying to compare two companies, let's say a clothing manufacturer in Durban and a tech startup in Cape Town. You're looking at their financials, trying to see who's in a better position. IAS 16 ensures they're both reporting their assets in a similar standardized way. It levels the playing field and makes those comparisons much more meaningful.
So it's about ensuring that everyone's speaking the same language, accounting-wise, no matter where they are in the world. That makes a lot of sense. But our sources also mentioned something about a ban on revenue-based depreciation methods back in 2014. What was that all about?
That's a really interesting point. Before 2014, some companies were depreciating assets based on the revenue they generated. The problem was that revenue can be all over the show, influenced by things like market trends or even a special promotion, which doesn't reflect how much an asset is actually wearing down.
So even if a piece of equipment is working overtime, its depreciation could plummet just because of a dip in sales, even though it's physically depreciating the same rate.
Spot on. That's why the folks over on the International Accounting Standards Board, the IASB, put their foot down. They realized that depreciation needed to reflect an asset's useful life, not the ups and downs of the market.
Makes sense. It's like judging a taxi's wear and tear based on how many passengers it carries rather than the kilometers it's clocked. You need a system that accurately reflects the real-world use of the asset. But tell me, who were the masterminds behind IAS 16 in the first place? Was it always the IASB?
Not quite. It all started back in 1993 with the International Accounting Standards Committee, or IASC. They laid the groundwork, and then the IASB took over, refining and updating the standard as the business world evolved.
So it's been through a few revisions, like a good Bowl Wars recipe being passed down through generations, getting tweaked and perfected along the way.
A great analogy. And those revisions have been crucial for keeping IAS 16 relevant and effective in an ever-changing business landscape.
I can imagine. But let's get down to brass tacks. What exactly falls under the umbrella of IAS 16? What kind of assets are we talking about here?
We're talking about tangible assets, the things you can see and touch, that a business uses for production, rental, or even administrative purposes. Think factory machines, company vehicles, office furniture, you name it. The key is they're expected to be used for more than one accounting period.
So it's all about those long-term assets that are crucial for a business to function, the things that help it generate income or keep things running smoothly.
Exactly. But what's interesting is what IAS 16 specifically excludes. For example, assets held for sale. Those fall under IFRS 5. Then there's the whole world of biological assets, like livestock or crops, which are covered by IAS 41.
Hold on. Does that mean a farmer's tractor is covered by IAS 16, but the cattle grazing in the field aren't?
You got it. And it gets even more specific. IAS 16 also excludes exploration and evaluation assets, which fall under IFRS 6.
Right.
And mineral rights and reserves, like those platinum mines we're famous for.
So the mine itself isn't under IAS 16, but the equipment used to extract the platinum is.
Precisely. It's a subtle but crucial distinction. Another fascinating exclusion is most biological assets, but with an interesting exception: bearer plants.
Bearer plants, that sounds intriguing.
Think of those beautiful vineyards in the Cape Winelands. The grapevines themselves, the bearer plants, are considered property, plant, and equipment under IAS 16, but the grapes they produce are not.
So the vines are the long-term asset, the engine of the winemaking operation, while the grapes are the product, destined to become that delicious pinotage. That makes a lot of sense. But when does something officially become an asset on a company's books? I mean, you can't just buy a stapler and suddenly declare it an asset, right?
You're absolutely right. There are specific recognition criteria that need to be met. First, there has to be a high probability that the asset will generate future economic benefits for the company. It needs to be more than just a fancy trinket. It has to have a real purpose in the business.
So a delivery backy for a courier company would clearly tick that box. But a foosball table for the break room might be a bit of a stretch.
Exactly. And the second criterion is that the cost of the asset must be reliably measurable. It's not enough to say, this looks malleable. You need to be able to put a concrete number on it.
Ah, so you need those invoices and receipts, proof that the asset was acquired at a specific cost.
Yeah.
That makes sense. But this applies not just to the initial purchase, but also to any additions or upgrades down the line, right?
Absolutely. Let's say a company invests in a new piece of equipment. Later on, they decide to add a safety feature to comply with regulations. Even though that feature might not directly contribute to the equipment's output, it's essential for the business to operate.
So it's like adding a roll bar to that backy we talked about
Yeah.
earlier. It's not about making the backy go faster, but it's crucial for safety and compliance, which ultimately allows the business to keep operating.
Precisely. And that cost gets added to the overall value of the asset. It highlights how IAS 16 takes a holistic view of what constitutes an asset's cost, going beyond just the initial purchase price.
I'm starting to see how much detail goes into this. So how does IAS 16 actually determine the cost of an asset? Is it as simple as looking at the price tag?
If only it were that simple. IAS 16 takes a more comprehensive approach. It factors in not just the purchase price, but also things like import duties, non-refundable taxes, and any costs directly attributable to getting the asset ready for use.
So it's about capturing those hidden costs that are often overlooked.
Exactly. Think about things like employee benefits for construction, site preparation, testing, and even the initial estimate of what it will cost to dismantle and restore the site once the asset reaches the end of its useful life.
Well, they really think ahead. But are there any costs that people often mistake for asset costs, even though they shouldn't be included?
All the time. A common example is general business expenses. You wouldn't include the cost of opening a new factory or launching a marketing campaign as part of the cost of a specific piece of equipment, right?
Right. Those are operational expenses,
Yeah.
not directly tied to the asset itself.
Yep.
Exactly. And then there are costs incurred before the asset is even ready for use. Think about running a machine below capacity during testing, or initial losses before production hits full swing. Those are part of the normal ebb and flow of doing business, not part of the asset's cost.
So it's about drawing a clear line between what contributes to the asset's value and what's just part of the operational landscape. But what happens once the asset is up and running are all costs from then on considered expenses.
That's where it gets really interesting. IAS 16 distinguishes between regular maintenance, which is expensed as it's incurred, and costs that actually add value to the asset, which can be capitalized.
Okay, give me an example.
Think about your car. Regular oil changes and minor repairs. Those are just the costs of keeping things running smoothly. But what if you have to replace the engine? That's a major overhaul that extends the life of the car and potentially increases its value.
So it's like the difference between fixing a leaky tap and installing a brand new geyser. One is just routine maintenance. The other is a significant upgrade.
You got it. And if that replacement meets the recognition criteria we talked about earlier, probable future economic benefits and reliable cost measurement, then that cost gets added to the asset's value.
So even though the asset is already in use, you can still add to its value if you invest in those major upgrades or replacements. That makes sense.
And here's where it gets even more nuanced. Even regular inspections can be treated as capital expenditures.
Wait, really? How does that work?
IAS 16 essentially views each inspection as replacing a component. The cost of the new inspection is added, and the previous inspection cost is removed. It underscores how crucial accurate record keeping is.
Wow, I'm starting to appreciate the level of detail that goes into all of this. So once you've figured out the cost of an asset, how do you track its value over time? Things depreciate, markets fluctuate. It can't just stay static, right?
You're absolutely right, and that's where companies have a choice to make. They get to choose their accounting policy for an entire class of PPE, things like land, buildings, machinery, and so on.
So it's not like they can pick and choose different methods for different assets.
Nope, consistency is key here. They have to decide whether they'll use the cost model or the revaluation model for a particular class of assets.
Okay, break those down for me. What's the difference?
The cost model is pretty straightforward. The asset is carried at its original cost, minus any accumulated depreciation and impairment losses.
That's simple enough. What about the revaluation model?
This one allows companies to adjust the carrying amount of their assets to reflect their fair value. It's useful in a market where asset values fluctuate significantly, like the property market, for example. But there's a catch. They have to revalue these assets regularly to keep things accurate.
So they can't just do it once and forget about it. They need to stay on top of those market fluctuations.
Exactly. And remember, this choice between cost and revaluation applies to the entire class of assets.
Right. So if they revalue one building, they need to revalue all the buildings in that class.
You got it. And no matter which model they choose, they still need to deal with the reality of depreciation, that gradual decrease in value over time.
Depreciation. That sounds about as fun as a tax audit.
Well, it might not be the most exciting topic, but it's crucial for accurately representing the value of assets over their useful lives. And IAS 16 gets quite specific about how to handle it.
Okay, I'm all ears. What are the key things to know about depreciation under IAS 16?
Well, first off, if an asset has significant parts with different useful lives, each part needs to be depreciated separately. It's acknowledging that different components wear out at different rates.
So like the engine and the body of a car would depreciate at different speeds.
Precisely. Then there's the choice of depreciation method. Companies need to pick a method that reflects how the asset's benefits are being consumed. There's the straight line method, which spreads the cost evenly over the asset's life. The diminishing balance method, which allocates more depreciation in the early years. And the units of production method, which ties depreciation to how much the asset is being used.
So a mining company might use the units of production method to depreciate their excavators based on the tons of ore extracted, while a company with office furniture might opt for the simpler straight-line method.
Exactly. It's about choosing the method that best reflects the reality of how the asset is being used.
Makes sense. But what happens if an asset's market value actually goes up? Do you still depreciate it?
That's a great question. Yes, you still depreciate the asset even if its market value is rising, unless its residual value exceeds its carrying amount. Remember, even well-maintained assets aren't immune to the effects of time.
So even if that vintage car you've been restoring suddenly becomes a collector's item, you still need to acknowledge that it's depreciating from wear and tear.
Exactly. And speaking of things that can impact an asset's value, we can't forget about impairment. That's when an asset's worth takes a hit, maybe because of damage, obsolescence, or changes in market conditions.
So like a hailstorm damaging a delivery truck or a piece of software becoming outdated.
Precisely. That's where IAS 36 comes into play, requiring companies to assess their assets for impairment and recognize any losses.
So it's like a regular checkup for your assets to make sure their carrying amount on the books still reflects reality.
You got it. And if there's any compensation from a third party like insurance, that gets recognized as income when it becomes receivable. But sometimes an asset reaches the end of the road and needs to be taken off the books entirely. That's where derecognition comes in.
So this is like the asset's farewell tour, its final bow on the balance sheet.
Exactly. Derecognition happens when the asset is sold, traded in, donated, or simply scrapped. And when it happens, any gains or losses are recognized in profit or loss, unless there's a leaseback involved, which is a whole other kettle of fish covered by IFRS 16. And there's an interesting quirk for companies that regularly sell assets they've been renting out. They transfer those assets to inventory at their carrying amount and then recognize the proceeds as revenue when they're sold.
So it's like those assets get a brief stint on the inventory stage before their final curtain call as revenue.
You could say that. It highlights how IAS 16 recognizes that businesses operate in diverse ways and that the accounting treatment needs to reflect those nuances.
It's not a one-size-fits-all approach.
Exactly. And that's why IAS 16 also places a strong emphasis on disclosure, providing detailed information in the financial statements to paint a complete picture of how a company is managing its PPE.
Disclosure. You mean companies have to spill the beans on how they're handling their assets?
Mm-hmm.
No hiding those skeletons in the accounting closet.
You got it. IAS 16 requires companies to break down their PPE by class, disclosing the measurement basis they're using, the depreciation methods they've chosen, the useful lives or depreciation rates, and the carrying amounts at the beginning and end of the period.
Wow, that's a lot of transparency.
Yeah.
But why is all this disclosure so important? Is it just to keep the accountants busy?
Think about it from the perspective of an investor or a lender. They're relying on this information to make informed decisions. They want to see how a company is valuing its assets, how it's handling depreciation, and whether those choices seem reasonable and in line with industry practices.
So it's about building trust and giving stakeholders a clear and honest view of the company's financial health.
Precisely. And it goes beyond just numbers. IAS 16 also encourages companies to disclose qualitative information that provides context and insights.
Like what kind of information? Give me an example.
Well, they might disclose any restrictions on their assets. Like if a piece of property is pledged as security for a loan, they might provide details about ongoing construction projects or contractual commitments for future asset acquisitions.
So it's like giving investors a peek behind the curtain to see the bigger picture of how the company is managing its assets, not just the current snapshot on the balance sheet.
Exactly. And if a company has revalued any assets, they need to provide even more detailed information, including the effective date of the reevaluation, whether they used an independent valuer, and what the carrying amount would have been if they had used the cost model instead.
So it's all about providing a complete and comparable picture, even when companies are using different valuation methods.
You got it. And let's not forget about those impairment losses we talked about earlier. IAS 36 requires even more specific disclosures in those cases.